Hello, this is Carlos Asilis from Glovista Investments. First, we wish you and your loved ones a happy and healthy holiday season. This week, beyond our customary market commentary for the week that begins on December 28th, we would like to share with you some of the key tenets of our 2021 investment outlook for global markets. First, in looking back at the week that just ended, global markets continue to consolidate, marking time, with some of the bellwether US indices essentially posting a flat performance for the week. This includes the S&P and the Nasdaq Composite. As has been the case over the last several weeks, small cap stocks continue to command performance leadership. Moreover, there was significant intra-week volatility as this past Monday, risk markets sold off on the news that a new strain of the virus that has been identified in the United Kingdom is far more infectious than previously expected. Nevertheless, risk markets managed to recoup most of the Monday session losses and close the week essentially flat. For the week that is about to begin, on Monday, December 28th, we continue to expect markets to consolidate and possibly edge higher on the back of seasonality, favorable seasonality backdrop, as well as expectations that a new fiscal relief program is likely to be approved by President Trump. Now, in terms of the calendar and the most important releases scheduled for the week, there are only 4. In the US, essentially, Dallas Fed Manufacturing, the Chicago PMI business sentiment indicator, pending home sales, and weekly jobless claims data. Now, moving forward and to share with you our outlook for global markets and the global economy for 2021, first off, we would like to emphasize that we do expect the global economy to post a healthy recovery next year. However, the first quarter of 2021 is likely to mark the weakest performing quarter on the back of the lagged effects of this second infectious wave that is taking place in much of the developed world. In part because of this short-term cautious stance that we harbor, along with the overbought conditions that equity investors are signaling in terms of the positions data that we track, we do expect downside risks to be concentrated in the earlier part of the year. In addition, on January the 5th, we have runoff elections in the state of Georgia, where 2 senatorial seats are up for grabs. If those seats do go to the Democrats, this, of course, is likely to unleash adverse fiscal expectations on investors, which could impact risk markets to the downside. So as we enter 2021, we believe that global portfolios should be positioned defensively. Secondly, for the year, we do have a bullish outlook on global equities, primarily on the basis of our macro thesis of continued expansion and a solid economic growth outlook for 2021 globally. But secondly, valuations for equities are very attractive compared to bonds. This is in very stark contrast to the year 2000, when equity valuations were extended, but bond yields were a lot higher, and therefore bond valuations were a lot more attractive than they are today. Therefore, in a global portfolio, equities are to be overweight versus fixed income in our assessment. And that's our stance for the year. However, over the course of the year, we're entering the year, again, well invested in equities, but defensively positioned in terms of the quality factor. Secondly, over the course of the year as a whole, we believe that it merits for any global portfolios to be overweight value-oriented sectors and underweight marginally growth-oriented sectors, not only on account of valuations, but also on account of the economic implications from the vaccination that is expected to take place globally, which is likely to favor value-oriented sectors. At a regional level, We believe that international markets within the equity space should be overweight, particularly emerging markets. And in the Eurozone region, we do favor, again, high quality markets, including the Swiss, German, Dutch, and French markets. We believe there are some opportunities in other markets such as the UK, Spain, and Italy, but the main allocations within the European investment theory is likely it should emphasize those four markets that we mentioned. In the United States market, we believe that industrials, materials, healthcare, and a number of industries within IT should be overweight. We would be neutral financials, and we would be underweight real estate and utilities. Within the fixed income space, we believe that the quality factor should be overweight even more so than within the equity space, primarily on account of valuations. With that, we would round off our views in the commodity space with a bullish outlook on precious metals. We believe they do offer diversification value to global portfolios on downside risks. With that, we wish you again a happy and healthy end of the year and beginning of a new one. Thank you very much for your time and your attention.